Hey, what's going on, guys? Leo. So I think that I figured out Trump's secret crypto plan for stablecoins and Ethereum. And I think that what it's going to do is it's going to send the market much higher and much quicker than I think anybody thinks possible. And they don't really have a choice. So their hand is kind of being pushed because of this looming government debt crisis that they're kind of going into. So before we get into all of that, I want to show y'all something really cool with Ethereum that I saw, and then we will get into the meat of it. So this is a first-person shooter game where every bullet fired is on, it's an on-chain transaction, which is just, I mean, this blew my mind. Every single one of these. Now, this is on Mega ETH, which is a layer 2 scaling solution for Ethereum with sub-millisecond block times. It's just incredible. So let's go ahead and dive in here. Okay, so quick recap. We're going to kind of go over some evidence to present to y'all. So this is David Sachs, and I want y'all to listen to what he has to say here.
Stablecoins really have the potential to ensure American dollar dominance internationally, to increase the usage of the U.S. dollar digitally as the world's reserve currency, and in the process create potentially trillions of dollars of demand for U.S. treasuries, which could lower long-term interest rates.
Keep that in mind. Trillions in demand for stablecoins. And this is the part that I missed the first time, potentially lower long-term interest rates. Now, the other bit of evidence here that we're looking at, so this just came out. So the FDIC clarifies the process for banks to engage in crypto-related activities. Now, stablecoin legislation hasn't come out yet, but we are seeing now the FDIC saying, hey guys, you can go ahead and start dealing in crypto. We're totally cool with it, even though the stablecoin legislation hasn't come out. Before this, we saw the Office of the Comptroller put out another letter saying that, yeah, you guys can go ahead and start dealing in crypto. We're totally cool with that. In the meantime, while we're still doing the crypto legislation. Now, just a reminder, I mean, I'm sure all of y'all are familiar with FDIC. This has to do with insuring your deposits at banks. And I think that what banks and institutions are going to do is they're going to be converting, as we just saw the other day with, I believe it was Vantage Bank. I talked about this like 2 videos ago, that they are going to start converting dollar demand deposits, meaning people's deposits into their checking accounts, into stablecoins. And so my question is, why not wait? Why not wait for the legislation to come out? Why is the government pushing so hard to get banks to go ahead, hey guys, start making the stable coins. We're totally cool with it. Come on, you start making those stable coins, guys. And then it hit me. Take a look at this. This is showing you the $9.2 trillion worth of government debt that needs to be refinanced this year. The problem, remember what I said about in this video where is it? David Sachs said that long-term interest rates would come down. That is the exact problem with this debt. You see, the average interest rate, the average weighted interest rate on this 9.2 trillion is 2.8. If they refinance this debt at today's rates, it would be 4.3%, and that would cost the U.S. government another $100 billion a year in interest payments. Now, we take a look at this quote from Scott Bessent, who is the Treasury Secretary, says, the president wants lower rates. Okay, well, why does he want lower rates? Yes, it's stimulative to the economy, but also they have $9.2 trillion worth of debt that needs to be refinanced. Bessent said this in February. He and I are focused on the 10-year Treasury and what's the yield of that. So Treasury yields are set by supply and demand dynamics. Basically, the more demand there is for treasuries, it raises the prices of the treasuries, but then the interest rates come down. So for example, if you have a bond that's like, let's say $100 for the bond, and then it's paying like a 2% interest, right? So as that bond price gets more expensive, the interest rate technically stays the same at 2%, but because the price of that bond has gone up to, let's say it just doubles, right? So now it's $200. Well, now the effective interest rate is no longer 2%, it's 1% because the bond is more expensive. So given that the bonds are priced on supply and demand, the only way to bring interest rates down is to increase the demand for these bonds. You can do that 2 ways. You can crash the economy with causing a recession and everything, which they're sort of doing to some extent, or at least they're creating a lot of fear, because People buy bonds because they're a very safe investment. They offer a very reliable return over time. So people, whenever you move into like a recessionary environment, people buy into bonds because they're safe. They're going to get a return. The other way is with stablecoins. So now let's go back to the first clip here with Treasury Secretary, David Sachs.
Currency, and in the process create potentially trillions of dollars of demand for U.S. treasuries.
Trillions of dollars of demand. The government needs to refinance 9.2 trillion. Now, I don't know whether 9.2 trillion is going to be instantly converted into stablecoins. What I can tell you is what would be required to bring the interest rates on the government debt down. So let's take a look here. I worked up some numbers. Okay, so the weighted average on this interest rate is 2.8%. That's 2.8 on the 9.2 trillion worth of government debt. If we assume for every 100 billion in treasury demand, it might lower 10-year treasury yields by 5 to 10 basis points. So basically, 0.05 to 0.1%. Now, this is based on historical bond market reactions to, like, for example, the Fed buying U.S. treasuries. So in this scenario, they need to lower interest rates on the 10-year by 150 basis points. So basically 1.5%. So coming down from 4.3 currently to the 2.8. And this is just to keep the cost to service the debt where it is right now. Low end estimate, let's say that 5 basis points per every 100 billion. So you take 150 divided by 5, it's 30, and then you multiply that by 100 billion. So we're talking about $3 trillion worth of stablecoins. On the high end, now this is high end as far as basis points per 100 billion. So on the high end, 10 basis points per 100 billion. So same calculation, it comes up to 1.5 trillion worth of stablecoins. So in order to get interest rates down, you create a ton of demand, like David Sachs said, trillions in demand for U.S. treasuries, because the U.S. treasuries have to back the value of these stablecoins. And you can have other assets in there as well, but a huge portion of it would be U.S. treasuries. Now, trillions, plural, remember what he said, trillions. So that falls within this range of 1.5 trillion to 3 trillion needed to bring the cost of servicing the debt down to that 2.8% level. Now, here's something else that's really interesting. So they have stated that they are going to cut off the treasury market to foreign markets, basically, like, so for example, like Tron and a lot of the treasuries that they hold, or these other chains that are like Tether, for example, that are outside the United States, from my understanding, they're going to be cut off from the U.S. treasury market, so they won't be able to hold U.S. treasuries to back their currency anymore. Now, what this means is this effectively could create a monopoly on stablecoins for Ethereum in U.S.-based companies. For example, like a lot of these, like the banks, for example, they're building on Ethereum to create their stablecoins, which they had just announced, like the dollar demand deposits that we had talked about. So if Ethereum suddenly, and I think that this could happen very, very rapidly, and again, it's very hard to time anything in the market, but in this case, not really, because this government debt is expiring this year, and it's going to be occurring throughout the year. So some of it's occurring, I believe some of it occurs like every couple of weeks. So this isn't like a hard date thing where at the end of the year, it all expires. This is going to be happening throughout the year, and that's why they are pushing stablecoins so hard, and they're trying to get these letters out to get banks to start creating stablecoins ahead of the stablecoin legislation, which is the Genius Act. But if I'm right, this basically means that we could see the stablecoin supply on Ethereum and its layer 2s go from 132 billion to 3 trillion this year, which is mind-blowing. I never would have guessed that this could happen this quickly. I mean, this is just shocking to me. Now, what that means is that the stablecoin supply on Ethereum would effectively go up 23 times where it currently sits, and that is a huge deal because the market cap of Ethereum is very closely tied to the amount of real-world asset, like the total value secured by the Ethereum network. So again, we come over here to ultrasound.money, and we can look at the market cap of Ethereum here is 230 billion. Its ERC value is 265 billion. NFTs, 12.6 billion. So you notice that the ratio between the Ethereum market cap and the Ethereum, the total value secured on the network is it's almost 1-to-1. In fact, it used to be 1-to-1 until we saw this little bit of a drop. So in my opinion, it's undervalued. But what this could mean is that the market cap for Ethereum could very easily go up to $1.5 to $3 trillion this year, if I'm right on this whole stablecoin thing. And I don't think what I'm suggesting is crazy. I mean, this is what government officials are actually saying, that there's going to be trillions in demand for stable coins and for U.S. treasuries. And if that happens, that will lower the 10-year yield because of supply-demand dynamics. So this could be a very interesting year. And I know a lot of people have been asking, Leo, the price is going down because of, what's going on. We have all this bullish news. And I think a lot of that is, obviously the tariffs are causing even the stock market to go down. So that has a huge role to play in it. We're just now starting to see global M2 money supply starting to go up. So I really don't think the actual bull run had started until quite recently. So I think this is going to be an incredibly bullish year. By no means am I thinking that we're going into like a prolonged bear market, especially with everything that's getting pushed through in the crypto space. So until next time, if you have any comments or questions, leave them in the comment section down below, and I'll talk to y'all next time. Take care.